After our previous videos on equity and debt mutual funds, many of you asked how to get a balance between risk and reward. That's where we have hybrid mutual funds. Hybrid funds invest in both equity and debt instruments that aim to provide growth with stability. Let's explore some popular types of hybrid funds. Aggressive hybrid funds are like 100-meter sprinters racing for potential returns. They invest 65 to 80% in equities, aiming for growth with a short time frame. Conservative hybrid funds are like marathon runners, wanting to maintain consistency throughout the race. Therefore, these funds invest 75 to 90% in debt instruments to reduce volatility. Dynamic asset allocation funds are like flexible gym-goers who adjust their workouts based on energy levels. In strong markets, they increase investments in equities with the aim to generate higher returns. While in a weak market, they shift to debt instruments to reduce risk. Multi-asset allocation funds are like dieticians, promoting a balanced approach by investing in at least 3 asset classes: equities, debt, and commodities like gold and silver. Just like a balanced diet, a balanced portfolio tends to maintain an overall financial health. Arbitrage funds are like gym trainers who guide you to achieve probable returns while minimizing injury. They capitalize on price difference between equity and derivative markets, using hedging strategies to reduce risk, thereby making your investments stronger. Equity saving funds are like new gym goers experimenting with workouts to find their fit. Equity saving funds combine equity, debt, and derivatives for building a well-rounded portfolio. So this was all about hybrid mutual funds. In our next video, we'll talk about liquid funds. Until then, stay healthy, keep learning, happy investing, and bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.